Welcome to Talk Tickers, where we strip away the fluff and get right to the numbers. Today, we are looking at the Q2 fiscal year 2026 print for Supermicrocomputer,
ticker SMCI.
And let's be honest, the numbers are messy. You have a stock that just ripped 16% higher, sitting around $34.22.
Mm-hmm.
But you also have profit margins that are, they're effectively falling off a cliff.
It is the ultimate contradiction, isn't it? If you only looked at the revenue line, you'd think this was the greatest quarter in hardware history.
Absolutely.
But then you look at the gross margin line, and you think the entire business model is broken.
Exactly. And that is the mission for this deep dive. We're going to figure out why the market is rewarding a company that is making less and less money on every dollar of revenue it brings in.
And we can just ignore the whole AI fatigue narrative today, because based on these numbers, fatigue is not the problem.
No.
The problem is the cost of doing business.
So let's set the table with those headline numbers that caused that 16% pop. The revenue. It was just monster territory.
Massive, $12.68 billion for the quarter. And to put that in perspective, the street consensus was sitting somewhere around $10.4 billion.
Okay, so a big beat.
But management's own guidance, the absolute top end, was $11 billion.
So they beat their own best case scenario by over $1.5 billion. That is not a rounding error.
No, that is a blowout. It's a 123% increase year over year. But what's even more impressive is the sequential growth. They're up 153% just from last quarter.
Which, brings us to the first critical piece of nuance here. You don't get a sequential jump like that without some anomalies. And reading the transcript, they flagged a massive catch-up dynamic.
Right. They clarified that about $1.5 billion of this revenue was actually delayed shipments from Q1. They blamed customer readiness.
Let's unpack customer readiness, because in the world of liquid-cooled AI data centers, that is a loaded phrase. That doesn't mean the customer, forgot to sign for the packet.
Oh, no. It means the physical building wasn't ready. We're talking about facilities that need these complex liquid cooling loops, specific power setups.
Reinforced flooring, all of it.
Right. So if a facility isn't ready to receive the racks, Supermicro physically can't ship them.
So Q1's pain became Q2's gain. That $1.5 billion just flushed through. But even if you strip that out, the organic growth is still undeniable.
It is. The demand is clearly accelerating. But that acceleration came at a severe, severe cost. And this is where we have to talk about that elephant in the room.
The gross margin. I looked at this number 3 times because I thought it was a typo.
6.4%.
6.4% non-GAAP gross margin. We are talking about a company that a year ago was at 11.8%.
Last quarter, they were at 9.5%.
So this is a compression of nearly 50% in their profitability in just 12 months.
It's a razor-thin safety net. When you're operating at 6% margins, you have almost zero room for error. If a shipment gets damaged or a component price spikes, you're suddenly losing money.
And the explanation for management was basically a triad of issues. They listed customer mix, expedited costs, and component shortages. I want to drill down into each of these.
Okay, let's start with expedited costs. This ties right back to that delay we just mentioned. Because those Q1 shipments were late, Supermicro had to rush to get them deployed in Q2.
Which means one thing. Air freight.
Massive amounts of air freight.
For anyone listening who hasn't seen these things, we aren't shipping a laptop. These are liquid-cooled server racks filled with GPUs and copper piping. They weigh thousands of pounds.
Putting that on a plane is astronomically expensive. It just burns cash. But Supermicro made the calculation that hitting the delivery window was worth that margin sacrifice. Speed over efficiency.
Which brings us to the second, and frankly much more concerning factor, the customer mix. Or as I like to call it, the whale.
The concentration risk here is, it's jaw-dropping. One single customer accounted for 63% of their total revenue this quarter.
63%. That's $8 billion from one company.
It effectively means Supermicro is acting as the dedicated builder for one massive hyperscaler. We can guess who, maybe it's xAI, maybe it's Meta, but the identity matters less than the leverage.
Exactly. If I'm buying 63% of your output, I own you. I dictate the price, I dictate the schedule.
And you're certainly not paying full retail markup.
Not a chance. This is the classic volume versus value trade-off. Supermicro has secured the volume, but they've just sacrificed all their pricing power to get it. That 6.4% margin is the receipt.
But there's a third leg to this margin stool that, to me, is the most frightening. Component shortages.
Yeah.
Specifically, memory.
Right, because Supermicro doesn't make the chips. They buy GPUs from NVIDIA, CPUs from AMD, and the HBM, the high bandwidth memory, from guys like Micron and SK Hynix.
Correct. And right now, HBM is the tightest commodity in the world. Prices are spiking.
So here's the scenario I'm picturing. Supermicro signs a contract with the whale 3 months ago at a fixed price. We'll build you this cluster for X billion. But in the meantime, Micron jacks up the price of memory by 15% because of shortages.
And Supermicro has to eat that difference. They can't go back to the customer, who hold all the leverage, and say, actually, we need more money. So that input cost inflation comes directly out of their gross margin.
It makes them a shock absorber for the supply chain. They take the hit so the hyperscaler doesn't have to.
That is the bearish view, yes. They're a low-margin bank financing the build-out for richer tech companies.
However, management is swearing this is the bottom. They're guiding for a bounce back in Q3.
They are. They claim the expedite costs will fall off now that the backlog is cleared. They're predicting, what, a 30 basis point improvement in gross margin next quarter?
30 basis points, that's 0.3%. So we go from 6.4% to maybe 6.7%. That feels like a rounding error, not a recovery.
It's a slow grind.
Yeah.
But their argument is that as they introduce their new strategy, DCBBS, the margins will structurally improve over time.
Let's talk about that acronym. DCBBS, Data Center Building Block Solutions. The CEO, Charles Liang, must have said it 50 times. It sounds like marketing fluff, but they claim it's a strategic pivot.
It's actually a fundamental change in what they sell. Historically, Supermicro sold servers. You buy the box, you rack it yourself. DCBBS means they are selling the entire data center interior.
So they're becoming a construction company.
In a way, yeah. They're selling the liquid cooling towers, the CDUs, the coolant distribution units, the plumbing, the power shelves, the backup batteries, and all the management software.
I see. So instead of me buying a server from them and then hiring a plumber and an electrician and a cooling specialist, I just buy the Supermicro data center in a box.
Exactly. And the whole value proposition is time to online, PTO.
Which is the only metric that matters in this AI arms race.
Absolutely. Think about the math. If you're a hyperscaler with 100,000 GPUs, every hour that cluster is sitting idle, you are burning hundreds of thousands of dollars. If Supermicro's DCBBS can get you online 3 months faster because it's a pre-integrated solution, that's worth billions.
So the pitch is, pay us a premium for the plumbing, and you'll save a fortune on the timeline.
Right. And structurally, those complex solutions, the cooling towers, the software, they carry much higher margins than the commodity server boxes.
Okay, so that is the light at the end of the tunnel if they can execute. But looking at the balance sheet, execution requires cash, and they are burning it.
Cash flow from operations was negative $24 million. But the real story is inventory.
Oh, I saw that. Inventory ballooned to $10.6 billion. It effectively doubled from $5.7 billion.
That is $10 billion of metal and silicon sitting in warehouses.
That is a massive, massive bet. They are buying inventory today to sell in Q3 and Q4. But we know how fast this tech moves. If NVIDIA announces a new chip or if the whale pauses an order.
That inventory turns from an asset into a liability very, very quickly. To mitigate that cash burn, they had to go to the capital markets. They raised nearly $4 billion in liquidity, a mix of a U.S. credit facility and debt in Taiwan.
So they are leveraging up to buy inventory to sell at 6% margins, hoping that volume and speed will eventually fix the whole profitability picture.
That is the gamble. And speaking of the future, the guidance suggests they are doubling down.
They raised the full year guidance to at least $40 billion. It was $36 billion before. And Charles was even more bullish than that on the call itself.
Oh, he was. He casually threw out numbers like $50 or $60 billion very soon. He is seeing demand that he believes is just insatiable.
He also mentioned they are already preparing for the next generation of silicon.
Right. NVIDIA's Vera Rubin platform and AMD's Helios. Supermicro's strategy has always been to be the first mover. They want to have the box ready the day the chip is available. That requires this massive inventory build.
So let's boil this down before we get to the trade idea. The bull case is the AI build-out is accelerating, SMCI is the biggest builder, and margins will recover.
Correct. The bull says don't look at the margin percentage, look at the absolute gross profit dollars and the revenue growth.
And the bear case is they are a low-margin integrator with huge customer concentration. They're taking all the inventory risk, doing all the hard work, but the component suppliers and the customers are keeping all the value.
And if they stumble, even a little, that 6% margin turns negative overnight.
Okay, that is the landscape. Now let's get to the part everyone waits for.
The "this is not financial advice" segment.
Disclaimer. We are not financial advisors. This is purely for entertainment. Do not trade based on two people talking on a recording. You will lose your money.
Please do your own diligence.
Okay, so I want to pitch a trade structure that capitalizes on this specific disconnect, the massive revenue versus the terrifyingly thin margins.
Let's hear it.
I'm calling this the liquid-cooled carry trade, or maybe the margin squeeze-out.
I like the squeeze out. How do we structure it?
Okay, leg one, you go long SMCI equity.
That's the scary part right there. You're buying the volatility.
Yes, but you are buying the volume. You're betting that the $40 billion revenue guidance is real and that they are the primary builder for AI.
Okay, but how do you hedge that 6% margin risk?
Leg two, you short a Dox Movers ETF or maybe a basket of their generic server competitors like Dell or HPE.
I see. So you're creating a pair trade. You're betting that SMCI's time-to-online strategy and their liquid cooling tech gives them a moat that the other assemblers just don't have.
Exactly. If the whole sector goes down, your short protects you. If the sector rallies, you expect SMCI to outperform because of its growth rate.
Okay, but that's a pretty standard pair trade. Where's the interesting part?
Here is the hedge fund twist. Leg three. We look at the volatility. SMCI implies these massive moves, so the premiums on options are sky high.
Right.
You sell put spreads on your SMCI long position, you're selling downside insurance to nervous investors, and you collect that juicy premium.
That's risky. If the stock crashes, you're on the hook.
Yes, but you're already long the equity, so you're committed to the bull case. But here's what you do with that premium you collected. You use it to finance call spreads on the memory manufacturers.
Micron, SK Hynix.
Exactly. Think about the mechanics we just talked about. Why are SMCI's margins crushed? Because memory prices are up. Who's profiting from that?
The memory suppliers. So you're basically hedging the earnings call itself.
Precisely. If SMCI's margins stay crushed, it's likely because memory prices kept going up. In that case, your memory calls pay out, offsetting the pain in your SMCI stock.
And if SMCI's margins expand,
it probably means component prices stabilize, so your memory calls might expire worthless, but your SMCI equity just rips higher because Wall Street loves margin expansion.
that is actually delightfully devious.
Yeah.
You're using the integrator's own volatility to pay for a hedge against their biggest input cost.
It covers all the bases. It respects the $40 billion in revenue, but it also respects the 6% margin danger.
It's complex, but it fits the data perfectly.
Before we wrap, there is one technical detail we have to mention. It happened at the very, very end of the call.
The correction.
The CFO, David Wigan, came back on the line right before they hung up to correct the share count.
This is critical for anyone building a valuation model.
Yeah.
He clarified that the non-GAAP fully diluted share count is actually 709 million.
Which was significantly higher than the number some analysts were using during the Q&A.
Dilution is the silent killer. Between stock size comp and the capital raises, that pie is getting cut into more and more slices. If you aren't using 709 million as your denominator for EPS targets, your price target is just wrong.
It's a good reminder that even when revenue doubles, shareholders don't always capture all of that value.
Always listen to the very last minute of the call. That's where the important stuff is hidden.
So, final verdict.
Watch the gross margin line in Q3. Ignore the revenue for a moment. If they can't get margins back toward 7% or 8%, the profitless growth narrative is going to stick, and that stock will struggle.
But if they hit that $50 billion revenue target and margins tick up,
Then you're looking at a beast that could dominate the data center for the next 5 years.
it is going to be a volatile ride. Thanks for listening to Talk Tickers. Keep your models updated, and we'll see you at the next print.